right here. Okay, so far we haven't really done any of the meat and potatoes part of valuation, right? We haven't talked about cash flows and growth and discount rates. Okay. So what I'd like to do for the rest of the morning session is actually show you how valuation plays out with the numbers, without giving you any detail about where the numbers come from. So it's a little unfair because I'm giving you the big picture first, but then we're going to come back and talk about risk-free rates and risk premiums, etc. Okay, so one of the things I will ask you to do for this class is pick a company to evaluate. I'll do the dirty work. I'll give you the spreadsheet, so you don't have to build the spreadsheet from scratch. Okay? I'll give you the spreadsheet. So this is all about you valuing your company. So we're going to go through the process of valuation. And I'm sure each of you is going to find variants of this as you go through. So you sit down to value a company. What's the first thing you do? You start with what you know. You start with the past, right? You look at the last year's income statement, the balance sheet. You don't stop at last. You look at 2 years ago, 3 years ago. What are you looking for? You're looking for clues. You're looking for, first, how quickly is this company growing? What kind of margins does it have? How much is it reinvesting? So I'm going to start with the number you're going to be looking for from last year. What kind of cash flow did your firm generate last year before debt payments? Why before debt payments? Because I'm going to value the business in this picture. So here's what we start with. To get the cash flows of the firm, you start with revenues, you multiply by the margin, you get an operating income. You act like you pay taxes on that operating income. So you net out the taxes, it's the tax effect. You come up with after-tax operating income. To get to cash flow to the firm, you always start with operating income. As opposed to what? As opposed to net income. Why is that? Why do we start with operating income rather than net income if you're trying to get cash flow to the firm? What's the problem with net income that will make it difficult for us to work with? It's after interest expenses, right? I want something before interest expenses. It's going to create other issues that I have to deal with later. We're going to start with operating income. So for those of you familiar with your accounting, operating income is going to be well above the net income number. I'm going to start with that. I'm going to act like I pay tax on the operating income. But that's just my earnings. So to get to cash flows, I need to figure out how much this company is reinvesting, what it's putting back in the business. And to measure that reinvestment, I'm going to use two generic line items. One is going to capture investment in long-term assets, land, building, equipment, machinery, and I'm going to capture that with the difference between capital expenditures and depreciation. What do capital expenditures capture? Capital expenditures are what the accountant says you're investing in long-term assets, land, building, equipment. Why am I netting out depreciation for that? CapEx is obviously what I'm spending on long-term assets. Why am I netting out depreciation? It's a non-cash item. I subtracted it out to get to operating income, right? Depreciation is an expense, but I haven't paid that expense. It's sitting in the bank still. That money is still there. I'm using that depreciation to cover some or a big portion of my CapEx. The difference between CapEx and depreciation is called net CapEx. It basically is what you're adding to your assets. So if your net CapEx is zero, you're keeping your assets fixed. If your net CapEx is negative, you're actually reducing your investment in capital assets. The net CapEx is positive, you're adding to it. So net CapEx is what you're investing in long-term assets. So from after-tax operating income, I subtract out the net CapEx. That's what you're investing in long-term assets. But if you're a retail store, think of how you grow. You open a new store, but before you open the store up for customers, what do you have to put on the shelves? Inventory, right? That inventory ties up cash. If you sell items on credit, that's receivables. Change in working capital measures what you're investing in short-term assets. Why do you have to do it? Because in some businesses, that's what you've got to reinvest in to grow, is whatever you're putting into working capital. So I start with after-tax operating income. I subtract out net capex. I subtract out change in working capital. Remember, since I'm working with last year's financials, your calculations and my calculations should match up because we're looking at exactly the same financials. We're estimating what the free cash flow to the firm was last year. And I'm going to be very specific. People use the word free cash flow incredibly casually in finance. I've seen people use free cash flow for EBITDA, and one analyst claimed revenues were free cash flow. I'm going to be very specific about why this is free cash flow to the firm. It's free because it's after taxes and after reinvestment needs. Why is it a cash flow? Because in a sense, I'm adding back depreciation and amortization, right? By netting it out against CapEx, it's like I'm adding that item back, so it's a cash flow. Why is it to the firm? Because it's before debt payments. In fact, if I subtract out debt payments from these cash flows, I'll still have free cash flows. It will become free cash flow to equity. So I take my most recent year, I compute the free cash flow of the firm. I go 2 years. So basically, I can take every past year for my company and compute what my free cash flow to the firm was every year. There are two things I will learn, or three things I will learn when I look at those free cash flows. One is I can see whether my firm is stable, growing, or declining. I can see what kind of margins it's delivering each year. Is it getting more profitable or less profitable? And I can also see what the company is putting back into the business, what it's reinvesting. You think, why do you care? First, when you as an investor think about reinvestment, remember when companies reinvest, it's less cash available to you, right? So it reduces the cash you get from the company. That's a bad thing, right? By itself. What do you hope to get as quid pro quo when a company takes your cash, remember it's your cash, and puts it back in the business? What's your hope that you will get in the future that will make up for it? Growth, right? Return on equity might be the vehicle I use. Dividends might be my eventual cash flows. The reason I'm willing to accept the fact that you put money back in the business is I'm hoping to get higher growth in the future. I want you to already start linking the two up. Because when you talk to management, what do they talk about? High growth. They have every management has great growth expectations. You know what brings them back to earth? You ask them, well, what do you need to reinvest to get that growth? Why does that bring them back to earth? Because that reinvestment will take cash flows out. Might even need that you might have to go to the market to raise even more capital. There's nothing wrong with it. You're doing it because you want to grow faster in the future. So we look at the past to get clues for the future. We don't look at the past to make it the vehicle for estimating all future cash flows, which is what I see in a lot of valuations. It's mechanical. You take last year's numbers, everything gets projected based on those. We look at the past to get a sense of what the company's been doing in the past. And get comfortable here, because this is your last comfortable zone, because you're looking at last year's numbers. Because your job in valuation is to not get focused on the past, but to forecast the future. So after you looked at the past, not just at your company, you could look at the industry, you could look at the market. Then I'm going to say, okay, you've done your research. Your job now is to forecast the future. And your first reaction is, I don't want to do it. There's too much uncertainty. But guess what? In valuation, you have no choice. You have to forecast the future. So I'll give you two scenarios. The easy one is you have a company with stable margins. What does that mean? If your margins are stable, you don't need to forecast revenues. You can just forecast your operating income, because the two will grow at the same rate. So you have stable margins. Here's what you need to do. You can actually estimate your expected growth rate in your company as a product of two variables. Remember that reinvestment you had in the company? Net capex and change in working capital? If I divide the reinvestment by our after-tax operating income, I get a number called the reinvestment rate. It's a percentage of your after-tax operating income that you're putting back in the business. So let's make up a number. Let's assume you're reinvesting 80% of your after-tax operating income back into your business. That's half of the growth equation. You're reinvesting a lot. The second question I'm going to ask you is, what kind of return are you making on that reinvestment? So let's say you take projects that make a 20% return on invested capital. You're taking 80% of your after-tax operating income, investing it in projects that make a 20% return on capital. Your growth is actually an output variable, not an input variable. You will grow, your operating income will grow at roughly 16% a year, 80% times 20%. So your margins are stable, life becomes mechanical. Your growth becomes return on capital times reinvestment rate. You get the expected operating income in future years. But let's stay with that example. Let's assume you have an 80% reinvestment rate, 20% return on capital. You're going to grow 16% next year. Then you do year 2, you make the same assumptions. Year 3, you make the same assumptions. Let me ask you a business question, not a math question. Is it getting more difficult for you as a business to maintain these numbers or less difficult? You see the question I'm asking? You're reinvesting 80% of your after-tax operating income next year, making a 20% return on capital. You're getting a 16% growth rate. That's good. And you're doing it in year 2, then in year 3, in year 4. Is it getting more or less difficult as you go through from year 1 to year 2 to year 3 to maintain these numbers? More difficult for 2 reasons, right? What's the first one? You're scaling up, right? That 80% reinvestment rate in year 1 might be 8 projects. That same 80% reinvestment rate in year 2 is 9 projects. Then it becomes 10 projects. Scaling up is hard to do. Is there a song like that? I think it's breaking up is hard to do. But maybe we need to sing a song. Scaling up is hard to do. Because companies, sometimes analysts completely miss this. They're using percentage numbers. They're saying, what's the big deal? I'm using the same percentage number. It becomes more difficult to maintain these numbers as you get bigger. Not impossible, because as the very best companies show us, the Googles, the Facebooks, the Apples, you can sometimes pull off this trick. But for 95% of companies, as you get bigger, guess what's going to happen? Your reinvestment rate is going to come down, your return on capital is going to come down. So the first thing that starts to work against you is scale. You know the second thing that starts to work against you is competition, because everybody looks at you, you're a great company, look, you're growing 16% a year, you're making 20, and then they don't stop there, right? They try to do what you do. It's the nature of competition. So the second thing that starts to work against you is competition starts to increase. And this is a good thing. You say, why is it a good thing? Because when did I say you could stop estimating cash flows? When your cash flows start to grow at a rate less than or equal to the growth rate of the economy, right? That's not going to be 16%. That's going to be like 3% or 2%. Built into every company, even the very greatest companies out there, are the seeds for the slowing down of growth. You'll see analysts say, but what happened in this company? You know how often I've heard this? In 1981, when I started, I was told IBM will never be a mature company. It's one of the greatest growth companies of all time. And guess what? By 88, IBM was a negative growth company. Then I was told Walmart will never be a mature company. It's amazing. And it was. But then 10 years later, its growth rates were in the single digits. 3 years ago, I was told Netflix will never be a mature company. It's got this amazing subscription machine. And now we're talking about Netflix growing in the middle six. Doesn't make them bad companies. This reflects the fact that over time, pressure is going to build on your company to get to lower growth rates. And my definition of a great company is you're able to delay that time, not put it off forever. You're able to push it up to year 20, year 30, year 35 because of things. This is what great management can do, right? Find ways to recreate or continue your higher growth rates for a longer period. So if your margins are stable, I'm going to focus on what your reinvestment rate is, what your return on capital is, use that to get your growth rate, and that's going to drive your cash flows. And over time, your growth rate is going to decrease, and eventually it'll become a mature company. On the first 2 companies I'm going to show you, I'm going to follow this pathway. It's a nice mechanical pathway that works for mature companies with nice stable margins. You know how often you're going to run into one of those companies? Maybe 1 out of 10, 1 out of 15. For the other companies you value, margins will be changing over time. If you're a young growth company, the margins are usually rising over time because your margins right now are either negative or very low, but over time you hope that they will improve because of economies of scale. If you're a company in a lucrative business earning 30% margins, but competition is coming in, over time your margins might actually decrease from 30 to 20%. If your margins are changing, you have no choice but to start with revenues. You see why? Because if your margins are changing, you have to start with revenues and estimate what the income will be because your margins are shifting over time. You have to start with revenue growth. What's going to drive revenue growth? Well, you've got to look at the size of your company, the size of the market, and make judgments on will my company get bigger or smaller over time. But you're going to start with revenue growth. Second, you got to give me a sense of where margins are going. I call this a target margin. Already you're going to get uncomfortable, especially when you're in the face of uncertainty. I don't know. I don't either. Nobody does. You got to make your best judgment. You could assume that they will move to industry averages, above industry averages. This is where the story you're telling for the company will determine where your company will end up. You're going to start with revenue growth. That will give you the revenues over time. You project out margins over time, starting with today's margins, going to a target margin. You multiply revenues by margins, you're going to get operating income each year. Now we're almost close to where we were when we did the stable margins. We got after-tax operating income every year. Now you got to estimate reinvestment, right? But here you got to tie the reinvestment to your revenues. Because your revenues are the number that are driving your growth rate. You got to tell me how much you're going to reinvest based on what your revenues are doing. So if you tell me your revenues are going to increase from $1 billion to $5 billion, I'm going to say that's amazing. But how much will you need to reinvest to get from $1 billion in revenues to $5 billion? I'm going to tie your reinvestment to your revenues using a ratio which basically tells me how many dollars of revenues I get for every dollar of reinvestment. So let me give you an example. The example that I gave you, the revenues are going to go from $1 billion to $5 billion. Let's assume your sales to cap ratio is 2, which means for every dollar of capital you invest, you get $2 of revenues. Help me out here. To get from $1 billion in revenues to $5 billion, how much reinvestment will I need if I get $2 of revenues for every dollar of capital? That's a $4 billion increase in revenues. If I'm getting $2 of revenues for a dollar in capital, I will need to reinvest $2 billion in net capex, change in working capital, acquisitions, whatever your reinvestment is. So when your margins are changing, you have to start with revenue growth, you have to estimate margins, and then you have to estimate reinvestment based on revenues. This is the most versatile valuation model because I can use it to value money-losing companies, money-making companies, young companies, old companies. Everything is now fair game. So the 90% of companies that are not mature companies with stable margins go revenue growth, margins, and reinvestment. I told you I was going to give you an Excel spreadsheet. It's not magical. It's built around those 3 inputs. So it'll ask you for your company what the revenue growth is going to be. It'll ask you for your company where do you think margins will end up. It'll ask you for your company how many dollars of revenues you will get for every dollar of capital. And I'll help you out. I'll give you industry averages as part of the spreadsheet so you can see what is typical for the sector. So you're not doing it in the dark, making up numbers. You can look at your company's history. You can look at industry averages. But the ultimate judgment is yours to make. That gives you your free cash flow to grow. And with both cases, your end game is you're telling me when your company will become a mature company, because then I can put that closure and estimate all of your cash flows beyond that. Let's go below the line and let's talk about the cost of capital. One of the problems is when you take a finance class, this becomes an equation, risk-free rate, whatever. I'm going to step back first and give you the intuition behind each of these costs and what you're trying to estimate. Then we'll talk about the models we can use. There are 2 ways you can fund a business. You can raise equity, or you can borrow money. I need a cost of debt, I need a cost of equity. Let's start with the easier of those 2 costs to estimate. Let's talk about the cost of debt. The cost of debt you're trying to estimate in a cost of capital is the rate at which you as a company can borrow money long-term today. Let me repeat that again. It's the rate at which you can borrow money long-term today. 2 key words there. One is long-term. You know why I'm putting that condition? I'm not going to let you tell me what your cost of debt is based on what you've actually borrowed, because you might borrow short-term to keep rates low, to make it look like you have a low cost of debt. And because this debt has to get rolled over, I'm going to say, I don't care what you borrowed money at or how much, whether you borrowed 1 year or 3 years. Give me the cost of borrowing money long-term. Why today? Because I'm valuing your company today. The fact that you were able to borrow money at a lower rate 2 years ago, 5 years ago, 7 years ago is nice, but it's completely irrelevant if I'm valuing the company today. Might not sound like I'm helping you, but I'm actually making your life easier by using this definition of debt. And here's why. If you look at most large companies, they will have 15, 20, 30, 40 different debt issues. Some bank loans, some corporate bonds, different rates, different maturity. I've seen people torture themselves by taking all of this debt, compute the cost of each debt, take a weighted average. I mean, bankers spend entire worksheets estimating the average cost of debt that a company has. Biggest waste of time ever. Because I don't care what you borrowed money at in the past. It's the rate at which you can borrow money today. So let's think of how we build to it. You know what your starting point is going to be? If you're a company borrowing money, you're never going to be able to borrow it less than the riskless rate. If it's truly riskless, you can't borrow at a rate less than that. So it's going to be riskless rate plus. Everybody agree with that? How much plus? Depends on how much credit risk there is in your company, right? So if I'm a banker, so think like a banker when you're thinking about cost of debt. If I'm lending to this company, how much credit risk? Chance I will not get paid back. And what are some of the things you're going to look at to make that judgment? Bankers have been doing this for 600 years, right? The Rothschilds were doing this in the 1500s. How did they decide what interest rate to charge somebody when they came to borrow money? What are the things they looked at? Sorry, what? What are some of the things? That's always the overriding condition. But what are some of the what are some of the factors that go into that?
Interest coverage.
One is they would look at the financials to see whether you're making a lot of money or very little money, whether your income is stable or unstable. Will they look at your history? How much security you can offer in case you're in trouble, though, for a banker. If you have to use the security to back up your loans, you've already lost the game, right? Right. But you're going to look at security. So if you have physical assets, fair or unfair, I might lend you more money than if you have intangible assets because I think I can liquidate it. Would your history make a difference? If you borrowed money from me in the past, am I going to look at that? Yeah, if you borrowed money and paid it back. If you're a private business, I'm probably going to look at your morals and ethics and how you... I mean, all these things have always been in play, right? You think this is a nightmare. How the heck am I going to check the morality of my CEOs if I'm going to value a company? We cheat with public companies. We let somebody else do the dirty work for us. What am I talking about? Who else is out there assessing credit risk that we sometimes fall back on as a... We look at bond ratings agencies. And think about it. That's basically the only role that bond ratings agencies have is they step in and say, hey, we'll do your work for you. We'll do the due diligence and attach a rating for the company. The risk here is they could screw it up. But the advantage is you now don't have to go through this torturous process, and you might not even be able to do it. How the heck are you going to access all that information? But either way, what are you trying to assess? You're trying to assess the default risk in a company, either with a rating or with a subjective judgment, and you're coming up with what's called a default spread, a spread you're going to charge over and above the risk-free rate. So if you're a nice, safe company, I might charge you 1% over the risk-free rate. If you're a risky company, I might charge you 5%. If you're a really, really risky company, I might refuse to lend you money, saying I can't even come up with an interest rate that works. So the cost of debt is going to be a risk-free rate plus this default spread. But there's a twist here. And here's the twist. Now, you know how politicians like to wag their fingers at companies and talk about how much they borrow and how terrible it is that companies borrow? You know why companies borrow as much as they do? Because in much of the world, the tax code is tilted towards debt as opposed to equity. Let me explain why. When you borrow money, you have interest payments, right? When you raise equity, you pay dividends or maybe whatever cash flows you decide to return, buybacks. When you make interest payments, what does the tax code in much of the world? I'll talk about the one part of the world where this is not true. What does the tax code in much of the world allow you to do when you pay interest payments as a company? It allows you to claim it as a tax deduction. In other words, you get a tax savings when you borrow money. So if you borrow money at 10%, you're effectively not borrowing at 10% because if you have a 30% tax rate, you're borrowing money at 7%. Do you see why? Because you borrow money at 10%, you claim the 3% tax benefit, and it's the cost of debt to a company is an after-tax cost of debt, and it includes the gift that the government is giving them by allowing interest to be tax deductible. Yes?
Sorry, so in the graph that you showed,
Yeah.
the relative risk measure, are you?
I haven't got to that yet. So the equity, the equity part, or we're still in the debt part, right?
Okay, so we're still talking about.
We're still talking about the risk. So basically, up to now, we've just done the cost of debt.
Okay. I'm sorry.
So we've got an after-tax cost of debt. Equity is going to be trickier, and here's why. Unlike a bank loan that comes with an interest rate stamped on it, you know what the cost of equity is? It's a number that people have in their heads when they buy my shares. Let me explain. I come and issue shares to you, and I'm a risky company. You're not buying my shares because you're feeling charitable or sorry for me. I hope not. You're buying it because you want to make a return, right? 18%, 20%, 22%. You know what the cost of equity is? It's that number that each of you have in your heads when you bought shares in that company. Now do you see why the cost of equity is going to be a nightmare to estimate? Because let's say I'm a company and each of you is a shareholder in my company. I've got to go around reading each of your minds, right? Let's say I could. I can't, so don't worry if you're thinking something else you're saying. But let's say I could read each of your minds. You know the second problem I'm going to face is after I've read your minds? Did all of you have the same number in your minds? Each of you came to a judgment on when to buy my shares. I mean, nobody sits there with a model and says, let's all agree on 12.35%. My second problem is going to be the numbers each of you expect to make from buying my shares is going to be different. And I can use only one cost of equity. This has been the challenge for 70 years in finance. How do you come up with one cost of equity, especially for a publicly traded company, which has thousands of shareholders? Think of a company like Facebook or Apple or Microsoft. How do you come up with it? And we've come to this uneasy solution that some of you are not going to like. I told you each of you is a shareholder in the company, right, with a different cost of equity. But let's make this specific. Let's say Elena owns 1 million shares and Clemente owns 100 shares. Whose mind do I care about more? I don't care about Elena. Who cares about Clemente? 100 shares. Already you can see out of the thousands of shareholders, I'm going to focus in on shareholders who own a lot of shares. But let's say both Clemente and Jillian both own 1 million shares. But Clemente is a founder who can't sell the shares because she wants control. She wants to stay as a shareholder. But Jillian is willing to sell the shares. She's an institutional shareholder. Who's going to affect prices more? In corporate finance, we call these investors marginal shareholders. They have a very special place because their views on risk essentially become the views that we all ride on because we have no choice. They set prices at the margin. You see how I made my life simpler? I've taken millions of shareholders, and rather than care about what each of them thinks, I've focused my attention on a subset of shareholders who own a lot of shares and trade those shares. You're saying, how the heck are you going to find out who these people are? It's very easy. You go to Yahoo Finance, pick any company. There's a little button where it tells you who the top shareholders in the company are. Take a look at the top 20 shareholders in your company. If any of you work at companies, it's a good thing to actually be aware of. You know who you're going to see on that list if you take mid-sized or large publicly traded companies? We'll talk about really small companies later. But who are you going to see on that list? You're going to see your name on that list? I don't want to insult you by, You're not going to see my name on that list. I'm never going to be a marginal shareholder at Apple. You know why? Because I'm not a billionaire. Think of how many shares you'd need to own in Apple to own 1% of Apple. You're going to see the usual suspects. You're going to start with BlackRock. If you're conspiracy-minded, these guys already own the world. It's amazing. You go to Indonesia, you pick the 10 largest companies. BlackRock is there. It's like, where's Waldo? It's everywhere. You're going to see State Street. You're going to see, in other words, you're going to see a lot of institutional investors. And if you see an individual name, it's usually a founder. You might see Mark Zuckerberg at Facebook, but he's not trading the shares. He's owning the shares, holding the shares. Do you see where I'm going to go next? If the marginal shareholders are big institutional investors, not only do they own your company, They own maybe 50 other companies, 40. I mean, I'm not even passing judgment on whether they're index funds or not. They're not owning one company. And it changes the way we think about equity risk. Because those investors tend to be diversified. The risk they see in a company is the risk that it adds on to a portfolio. Let me repeat that again. The risk that institutional investors see in a company is the risk it adds on to a portfolio that they already have. You see, so what? You know that 80% of the risk in a company is company specific. Things that the company can do better or worse than expected. That you can build a store in a wrong place if you're a retailer, or in the right place if you're a retailer. That you're a movie company that makes a huge hit or a huge mess. So company specific. Remember the law of large numbers and statistics? What it basically says, if you have 50 companies where strange things can happen to individual companies and cut in both directions, across your portfolio, what's going to happen to that risk? It's going to get averaged out. It's not rocket science again. For every company where something worse than expected happens, for another company, something better than expected happen if it's company specific. So if you're investing in a drug company, one drug company might have a drug that crashes and burns, and another drug company might be Moderna to make up for the company that crashed and burned. It changes our perspective on risk. Now, part of you is saying, but what if I have a really small company or a private company where this is not true? We'll come back and isolate them. For most publicly traded companies, though, risk is measured through the eyes of a diversified investor. Now, if you say, what if I choose not to be diversified? That's your problem, not the market's problem. Don't expect to get rewarded for being stupid and rash. I mean, that's like living across 6 lanes of a highway from a brokerage house which you used to buy and sell stock. And every morning you get up and you run across the highway. You say, look, I'm taking a lot of risk. I should be making 50% returns, right? No, you're just going to get run over for no reason at all. I'm still amazed by people who think their vision of risk is what matters because they've chosen to put all their money in Tesla. That's your problem. If you make money, great. But if you lose money, don't come mourning to me saying, I'm not being rewarded for the risk I take. So when we think about cost of equity, I want you to think about cost of equity not through your eyes or my eyes, but through the eyes of BlackRock and Fidelity, because that's what's going to drive the cost of equity for a company. So let's build up to that cost of equity. We're going to start with the risk-free rate. See, already, without a risk-free rate, you're kind of stuck doing in valuation. That should be easy, right? Well, I wish it were. Maybe in US dollars, maybe in Swiss francs. But do you really know what the risk-free rate in Nigerian naira is? Or Zambian kwacha? Or Indonesian rupiah? We're going to come back and talk about risk-free rates more specifically because it's easier talked about than actually done. In some currencies, getting the risk-free rate can itself be quite a chore, but you've got to do it if you want to value a company in that currency. So I'm going to start with the risk-free rate. Just like I did, the same risk-free rate that drives the cost of debt is also driving my cost of equity as my starting point. But here's how I get that additional premium for my equity. First, I estimate what I'm going to call an equity risk premium. But that's just a fancy word for price of risk in the equity market. What are investors in the equity market demanding for investing in the average risk stock? You say, how would I know that? I'll give you a couple of ways in which people try to estimate it. But again, you cannot do valuation if you don't know what that number is. So let's say the price of risk is 5% for an average risk company. I can't just add that on to come up with the cost of equity for your company because your company might be more risky than the average risk company or less risky than the average risk company. So I'm going to multiply that price of risk for the average risk company by how risky you are relative to other companies. Think of this as a relative risk measure. In fact, let's scale it around 1. 1 means your average risk. Above 1 means you're above average risk. Below 1 means you're below average risk. The relative risk measure is just a measure of how risky are you as a company relative to the typical company in the market. I'm leading in baby steps to a Greek letter that we end up using, but I'm saying the Greek letter is just the stand-in for relative risk. You know the Greek letter I'm talking about, right? Beta. Don't get too caught up in betas. Betas are just a measure of relative risk. If you don't like betas, just come up with a different measure of relative risk. It'll work. Your objective is to come up with a cost of equity that essentially reflects the currency in which you're doing the valuation, the risk premium of the markets you operate in. Already you can see that might be different if you operate just in Africa as opposed to only in the US, and how risky you are as a company. Those numbers feed into a cost of equity. The cost of capital is a weighted average of those two numbers. Weighted by what? Weighted by how much of each you use in funding your business. So you use 80% equity, 20% debt. I'll use those weights of 80 and 20. Now, because I'm valuing the company, I'm going to measure those weights based on market value, as opposed to what? When I ask you what the equity in a company is after an accounting class, what do your accounting professors train you to do? Go to the balance sheet, look up shareholders' equity. Let go of that notion. That's a book value of equity. God only knows what it actually measures. The weights are market value weights. One final question, though. Let's say I'm looking at a company that's a young company. What kind of weights should I expect to see up front for the company in terms of equity and debt? Mostly equity, unless they get desperate and borrow money. Why? Because you can't afford to borrow money if you're already money losing. Right? Desperation might drive you there, but venture debt is an oxymoron. It's really a way of blackmailing you to get better terms from you. It's venture equity you're looking for. So when you start your valuation for a young growth company, you might be 100% equity, which means your cost of capital is going to be a cost of equity. But on your spreadsheet, what are you doing to this company? You're growing its revenues, you're improving its margins, you're making your small company almost magically become this large money-making company. So here's my follow-up question. As that's happening, what should happen to your debt ratio, your capacity borrow? Your debt ratio should change, your risk should change, your cost of equity should change, your cost of... What I'm laying the foundations for is, in too many discounted cash flow valuations I see, people estimate one cost of capital up front, and they leave it stuck for the rest of eternity, even as a company will go from young money losing to large money making. So what you're going to see in my valuations is a starting cost of capital. But as my company evolves, especially if it's a changing company, I'm going to change the cost of capital over time. I've got my cash flows over time. I discount them back at the cost of capital. You know what I've just valued? I valued the operating assets of the company. You see, as opposed to what? What is a measure of earnings? Operating income, right? I have valued every asset whose earnings are part of operating income. You know what I haven't valued yet if I'm valuing Apple? What's an asset that almost every company has on its balance sheet whose income is not shown as part of operating income? Cash. If you have cash as a company, income from cash always shows up below the operating income line. You say, what's the big deal? It's $200 billion at Apple. This is not penny change. I haven't valued it yet. So I'm going to add on cash because I haven't valued it yet. You know what else I haven't valued? If you have cross holdings in other companies, own 3% of another company, 5% of another company, income from those cross holdings will not show up as part of operating income. They will show up below the operating income line as income from... You think, how big can that be? In the case of Alibaba, what's the biggest... Where does Alibaba get the biggest chunk of its value from? One holding. I'm sorry, the question was phrased. If I take SoftBank, what's the biggest chunk of value? It comes from one holding in Alibaba. It's a minority holding. If you have minority holdings, I've got to bring them in. That's what I mean by non-operating assets, is things that don't show up in operating income. You've got to mop up.
Will that include land?
Depends on what's on the land. If there's a factory on the land, what's the problem? You can't count an asset twice, right? If I build a factory on the land and I generate cash flows from the factory and I'm counting the cash flows, I can't count the land. If I have vacant land and you're just sitting there and I have no plans to use it, then clearly you have to. This is actually a very good question because we're going to ask questions about Because I see a lot of double counting sometimes happen. When people do a DCF and they say, I have this great, headquarters building right in the middle of New York. I'm going to add the value of that building on. You can't do that. Because that building is full of traders who create the income for you, which I've counted as part of your cash flows. So as long as you don't violate the rule of not counting both the cash flows on an asset and the asset itself, you might have to decide whether it's worth more as an asset that you just sell off and just keep the land. In which case you can bring, so that's actually a non-operating asset if it's truly vacant land. But if there's something on the land, you've got to ask, have I counted it already? In fact, make that your refrain. Have I counted this already? If the answer is yes, don't count it as a non-operating asset. But if the answer is no, you might have to bring it in to clean up. So we'll come back and address what some of those non-operating assets might be. So you get the value of the operating assets, you add cash, you add the value of non-operating assets, you got the value of the entire firm. I subtract out the debt that I owe. I get the value of equity. This is the generic picture. I don't care where in the world you're located, what type of company you're. This is where I'm leading to, no matter what company I value. So what I'd like to do is value 3 companies for you. And as I said, when I show you these valuations, you're probably going to say, but where did that number come from? Kind of hold off on those questions, because this afternoon is going to be all about filling in the details on where I get risk-free rates, betas, risk premiums. So the first company I'm going to value is a company called Amgen. You familiar with Amgen? It's the largest biotechnology company in the world. Okay? It's really more pharmaceutical company than biotechnology company. I've always thought of biotechnology companies more as young pharma companies versus older pharma companies. It's the largest biotechnology company in the world. And this is a valuation I did on May 1st of 2007. I did it for a group of Fidelity analysts in Boston. And I have to tell you, I love valuing companies in April and May. You think, why? Not because spring is in the air. But what's the document that most of us depend on when we value companies? What's the document you keep going back to over and over again? The annual report, right? Basically, And if you have a calendar year end, which is the case for 80% of companies in the world, you know when you get that annual report? It used to be April or May. Now it's closer to March because with the online annual reports you can get it, but you never get it on January 1st. It's amazing how I see people value companies as of December 31st. You know what they do? They take the annual report that ends December 31st, say, this is a valuation as of January 1st. Not unless you find a time machine. Because on January 1st of the year, you know what your most recent 12 months will look like. It'll be through September 30th, not through December 31st. So this is a valuation with the 2006 annual report has just come out. So I'm going to take you through what I estimated. I'm going to tell you my story for Amgen. You're going to see me do this in every valuation. There's going to be a story that drives the numbers, and you're going to see how this plays out. So I looked at 2006, and here's what I saw. I saw an immensely profitable company. Their operating income was $7,336 million. They made a lot of money. They paid a 28% effective tax rate. You're going to see 2 different tax rates roll through this valuation, and we'll talk about why I'm using 2 different tax rates. I'm using an effective tax rate. You know what an effective tax rate measures? It's just an average tax rate across all your income. It's taxes paid divided by taxable income. And because I'm looking at all your income, I'm using that effective tax rate. As opposed to what? What's the other tax rate that you think about? A marginal tax rate. The marginal tax rate is the tax rate in your last dollar of income. Here, because I'm looking at all my income, I'm going to use the effective tax rate, 28%. That tax rate could change over time because to the extent that your tax deferrals leave, you might have to move towards a marginal, but I'm starting with a 28% effective tax rate. The company made $6.058 billion in after-tax operating income. I'm following the script, right? I've got the after-tax operating income. Then what did I do? I looked up Capex and depreciation. May I ask you a question on the accounting financial statements? Which financial statement would I go to get numbers on depreciation and Capex? The balance sheet is going to be very diffused. I'm going to go to the statement of cash flows, right? Because there should be a depreciation line item right in the operating section and a Capex line item. That's where I went. And I knew instantaneously that the accountants were lying. Because here's what I saw. I saw a net capex, according to your accountants, of $255 million. You think, what's the big deal? Remember, this company has $6 billion in after-tax operating income, and if the accountants are right, they're reinvesting almost nothing. But here's why it's a lie. You know how accountants measure capex? Land, building, equipment, machinery, factories. What's the biggest capex? If you define capex as investments, expenses you're putting in to get long-term growth, what's the biggest capex for a pharmaceutical? It's R&D. And what do accountants do with R&D? Screw it up big time. They expense it. We'll come back and talk about the flawed logic that leads them there. But I'm not bound by what accountants do. Accountants can do whatever they want. That's their game. My job is to, whether it's a matching or a mismatching principle, there's really no principle involved. It's just screwed up. Right? So I redid the accounting statements, and I moved R&D, and we'll talk about how I did this. I capitalized R&D. It's not as simple as taking all the R&D now, because you've got to act like you've been capitalizing it. So I'll go through the process of how I do this, and why this is more something that's a rule than the exception. Because think about it. What's the biggest capex for a Netflix or an Uber? Sorry, what? Content for Netflix, and what else? Acquiring users, acquiring subscribers becomes part of what they do. Because if your business is built on a platform, and the way you market yourself is look at how many people are on my platform, the cost of acquiring customers and users becomes part of the capex. I've opened the Pandora's door, the Pandora's box, and I've got to essentially deal with the fact that a lot of things that accountants expense should not be expensed. Accounting as we know it was designed for the old-time manufacturing company. It's fraying at the edges. When you look at platform companies, technology companies, pharmaceutical companies, in fact, it's more the rule than the exception that the accounting doesn't work. Yes?
But you've deducted the R&D in your EBIT.
And that's a good question. The EBIT I'm using is not the EBIT that they're reporting. I had to so that's why I said I have to redo the financials. Does everybody get Salim's point, which is I can't just leave the EBIT where it is because the accountant expensed it. I had to redo the income statement, the balance sheet, and the statement of cash flows I can leave aside. But the income statement balance sheet had to be completely redone. So I'll take you through the process because I do this almost routinely with almost every company. And it's built into the spreadsheet I'm going to send you. So if you decide to capitalize something, there's actually a worksheet that will let you capitalize any expense you want. So you're valuing Uber and you decide you want to capitalize rider acquisition costs, I'm going to give you this little worksheet where you can use. That adds another $2.2 billion to my net capex. So now I'm getting a little more substance to my net capex. It's not the $255 million the accountant told me. It's much higher if I add the $2.2 billion, but I'm not quite done. If you define net capex as what companies are reinvesting because they want to grow faster in the future, there are two ways companies can reinvest. One is with internal projects, which is what traditional net capex measures. But if you're in a hurry, what do companies do when they want to grow? They go out and do acquisitions. I've never understood why acquisitions are treated as separate from traditional. It's just gigantic capex. Microsoft's biggest capex in its history was when it bought Activision for $76 billion. To call it anything other than capex, I think, treats acquisitions as if there's some special gain. I'm not saying they're good or bad. That acquisition could be good, but I should be treating it like any other capex. So I added acquisitions, and look at how much it adds to Amgen's net capex. My net capex goes beyond the accounting net capex. It's accounting net capex plus the R&D capitalized plus the acquisitions, and when I'm done, I'm getting a net capex of $6.443 billion. Amgen had a good year in terms of profitability, but it reinvested even more than its after-tax operating income in net. How do you do that? How do you reinvest more than your earnings? What am I implicitly telling you Amgen did during 2006? It actually used primarily equity. You know where it used the equity? When it did the acquisitions, what are the two ways you can pay for acquisitions? You can pay with cash, we can pay with shares. Some of the acquisitions were funded with shares. So a chunk of the acquisitions are coming from equity. But the bottom line is, if you take the total reinvestment that Amgen had in 2006, as a percentage of the after-tax operating income, it is 107%. Now, is that good or bad? Well, it's half the equation, right? Reinvesting a lot does help you grow. But what's the second question you need to answer? How well is Amgen reinvesting? What kind of returns is it making on projects? Unfortunately, as an outsider looking at Amgen, you don't get to see capital budgeting projects. What do you get to see? You get to see the entire company. So here's what I did. I computed the return on capital that Amgen was earning as a company. And I'll come back and go through the mechanics. It's a pretty simple, calculation. There's a lot of tweaks you might have to throw in. The return on capital that Amgen had in 2006 is 16.71%. Remember I said we look at the past not because it's driving the future, but to get some clues about the future. What am I learning about Amgen by looking at it in 2006? First, it's a company that's very profitable. That's good. Second, it's a company reinvesting a lot. That could be good or bad. But to kind of condition that question, it's also earning a pretty decent return on capital. How do we know whether return on capital is, that's 16.71%. What are the two numbers I can compare it to get a sense of whether Amgen is doing a good job or a bad job on its projects? I could look at the industry averages, right? If everybody's making 25%, you're making 16.7%, you're doing well, but not as well as the rest. But there's another number in my own valuation that I'm going to look at to make sure that you're passing muster. What's the other number in my valuation that I should be looking at? What are they investing in the project? Capital, right? Their cost of capital is 10.9%. They're earning 16.7%. Let's pause there. I don't know whether you remember your first econ class. In Econ 101, we start with this limiting case of perfect competition. If you have perfect competition, you know what the return on capital for every company should end up close to or at? You should end up at the cost of capital, because with perfect competition, the minute you make more than your cost of capital, competition comes in and drives out those excess returns. When you do a valuation and you're defending a valuation, you're hoping and praying for mechanical questions. You know, a mechanical question is, show me how you computed return on capital. I love those questions. They're so easy. It's just, this is the after-tax, this is the denominator, this is the numerator. You know the question you really should be asking me here is, if they're making 16.71%, the cost of capital is 10.9%. Implicitly, what am I telling you about competition? That there's no perfect, that there are barriers to entry, that there are competitive advantages. So what do you think the competitive advantage is that allows Amgen to make more than its cost of capital? In fact, this is one of the easier cases to answer the question. It's the fact that they're legally protected from competition, right? Their biggest blockbuster drugs have patents on them, and there are patents that are actually enforced. These are the questions that when you talk about stories, those are the stories that you need to address. Don't just show me a return on capital above the cost of capital and ask you, why is your company earning more than the cost of capital? If you haven't thought through a really good explanation for why it can keep doing it, then your valuation is already in trouble. So I looked at the past, I saw what they'd done in the past, and I made a judgment call. In 2006, Amgen had been run by the same management for a while. They were well established. There was no threat to them. I assumed the status quo. In other words, that they would continue to run the company the way they've done it in the past. How will this play out? First, I think the margins we're earning were margins pretty close to industry averages. I thought they could maintain those margins. And if you can maintain the margins, remember the easy path I can take? I can assume what their reinvestment rate and return on capital is, and the product of those two numbers will give me the growth rate. Now, if you look at 2006, the reinvestment rate was 107%, the return on capital was 16.7%. That's think of that as a fact. It's coming from the past. My job in valuation is to make a judgment, an estimate for the future. So I started with the reinvestment rate. I initially thought about using the 106.98% from the most recent year. But there was something about 2006 that gave me pause. It was a big acquisitions number. You know why that gave me pause? Because acquisitions tend to be lumpy. What does that mean? You have a company that does a lot of acquisitions 1 year, often will lay off for the next year or two, and I'm worried that I'm taking a big acquisition year and making that my steady state. Let me ask you a common sense question. If you're worried that 2006 might be an outlier, what's the easiest way to check to see if it's an outlier? Well, look at 2005 and 2004 and 2003, 2002, look at industry averages, and that's exactly what I did. The average reinvestment rate that Amgen had over those 5 years was 60%. In other words, there were 2 years where they acquired a lot of companies, 3 years where they did no acquisitions. The average reinvestment rate is 60%. Since my story is a status quo story, the same management is running the company, I assumed that they could maintain that reinvestment rate for the next 5 years. We'll talk about what happens after year 5 in a minute. So that was my first assumption. Second, I looked at the return on capital. Again, I was worried because returns on capital can jump over time, right? Profits can change, invested capital can change. And as with my reinvestment rate, I looked at 2005, 2004, 2003, 2002. And there, I noticed a trend. And here's what I saw. In 2002, the return on capital was about 18%. Then it went to 17.7%. So each year, it's drifting down. Why? The company's getting bigger. Its blockbuster drugs are getting to be a smaller percent of revenues. Scaling up is working, yes, but very gradually. I assumed that that would continue to happen into the future as well. You're saying, how do you know? I don't. This is my story, my valuation, my investment. And guess what? If you have a different story, and you should, you might have a very different judgment to make about reinvestment. I'll give you a couple of scenarios where I'd have used a different set of numbers. So I assumed a return on capital of 16%. For the next 5 years, you take the product of those two numbers, I get a growth rate of 9.6% a year. I'm not estimating growth. I'm letting the reinvestment rate and return on capital drive the growth in my operating income. So for the next 5 years, I grow 9.6% a year and reinvest 60% of my after-tax operating income every year, giving me a free cash flow. Now remember, this company is already a big company. I'm letting it grow at roughly 10% a year. It's getting bigger and bigger and bigger. And I'm getting more and more uncomfortable assuming it can keep doing this. So I get to year 5. And I say, you know what, I can't let this go on. The company's getting way too big. I want to turn the tap down, but I'm kind of stuck in year 6 now. And think about it. Who really knows what's going to happen in year 6? You're stuck in this no man's land. You say, I don't know what's going to happen. So I'm going to do something very strange. Because I'm uncertain about year 6 and year 7 and year 8, I'm going to jump to year 11. You're saying, if you're uncertain about year 6, what's so special about year 11? In year 11, I'm going to assume that Amgen will become a mature company. What do mature companies do? They grow at a rate less than or equal to the growth rate of the economy. I think their growth will go from 9.6 down to 4%. We'll talk about why 4%, but in this case, I think that's a growth rate they can maintain forever. If I valued Amgen today, there is zero chance I could use a 4% growth rate forever. We'll talk about what was different about 2007 that allowed me to do it, but I assumed a 4% growth rate forever. I've made them a mature company. You have to do this with every company, but when you make a company a mature company, you have an obligation to give it all the characteristics of a mature company. Let me explain what those are. First, remember that 16% return on capital I was assuming for the next 5 years? I'm upbeat about the near term. I think as companies mature, guess what's going to happen to the return on capital? It's going to drift down. Often to the cost of capital. For many companies, once you become a mature company, you actually cannot earn more than the cost of capital. You're in a very competitive business. Pharmaceutical companies, though, those patents have a really, really, really long lifespan. So I'm going to bring the return on capital down, but I'm going to bring it down to just 10%, from 16 to 10. So I've made the company have lower growth, lower returns on capital. But I'm also making this company a much safer company, right? If it's a mature company with stable margins and stable returns on capital. See this cost of capital of 10.9%, it reflects Amgen as it is today, which is a high growth company doing a lot of R&D. But after year 10, I expect it to become a less risky company. How much less risky? The cost of capital that I'm estimating for Amgen after year 10 is closer to 8%, closer to that of the very largest, most mature pharmaceutical companies. So here's what I have. I have the growth rate of 9.6%, the reinvestment rate of 60% for the next 5 years, and in year 11, I have a 4% growth rate. And because my return on capital is 10%, I'm reinvesting 40%. To get that growth rate, the return on capital, I'm basically backing into my reinvestment. I have this blank period in my spreadsheet. Years 6 through 10 are not done yet. And I'm looking for the easiest and laziest way I can fill in the numbers. So help me out here. I have 9.6% growth for the next 5 years, 4% after year 10. So how do you think I got the growth rates in year 6, 7, 8, 9, and 10? What's the easiest way to get from 9.6 to 4? You take the difference, divide by 5. You're saying this is so unsophisticated. Guilty as charged. I step it down. My reinvestment rate for the next 5 years is 60%. My reinvestment rate after year 10 is 40%. You know how I got from 60 to 40? I went 60, 56, 52, 48, 44. My cost of capital for the next 5 years is 10.9%. The cost of capital after year 10 is 8.08%. I took lead. Basically, so the years 6 to 10 are what I call a transition period. I'm just adjusting down from where I am today to what I think this company will look like as a mature company. You fill in the details. You can see my operating income growing at 9.6% for the next 5 years and then declining rates then. But take a look at what's happening in my free cash flow. It's growing at a higher rate than operating income because my reinvestment rate, especially after year 5, is getting lower. I'm reinvesting less. I am building an internally consistent story, a story of a company that's going to continue to be successful, but over time is going to approach maturity. And I'm going to show that my growth rate, my reinvestment rate, the cost of capital. And what do you get as a present value? We discount those cash flows, and the elephant in the room, the big terminal value, which is the cash flows beyond year 10, is a present value of $94.2 billion for the operating assets. That's all the cash flows discount back to that. I added cash because I haven't valued it yet. Luckily, Amgen had no cross-holdings to worry about, no non-operating assets to think about. And I subtracted our debt, I get a value for the equity of $87.2 billion. I'm almost home. I subtract out options. What are these options you think of? If I'm a stockholder in a company, what are the only options that affect me as a shareholder in a company? What can a company do that can affect my value of equity? These are management options. Every time companies give options or restricted shares to management, this isn't free currency. It's a piece of your equity being given to them. I'm not saying it's a good thing or a bad thing. That might be the only way you can keep employees if you're a young company. But it's definitely not free currency. I'm cleaning up for the fact that in this case, Amgen over time has granted options. It's not a big deal. You can see it's only $479 million. It's like penny change. You're saying, why are you wasting your time? A little later in this class, I'm going to show my valuation of Amazon in January 2000. And you know what you're going to see options do? Take away about 25% of the value of your equity. January 2000, as a young tech company, they've been giving away options as if they were going out of style. This company had given away 20% of equity. And that had to be taken out of the equity. In this case, I removed the option to the equity, saying that's not my equity anymore. I divide by the number of shares. I get a value of $74 per share. When you value publicly traded companies, you're always 2 questions away from being exposed as a fraud. I told you I did this on May 1st of 2007 in real time. I finished valuing the company. The first question I was asked is, what's the stock price? And I said, it's $55. That was the easy question. The second question was, the answer to which is going to tell you whether I have faith in my own valuation. Stock price is 55, my value is 74. What's the question you need to ask? Did I buy it, right? It's as simple as that. What are the 3 answers I can give you? No, in which case, what have I told you about my own valuation? Nice number crunching exercise. I have no faith in it. I can say yes and lie. You have no way of checking. Or yes and buy. I did buy Amgen on January 1st, or now May 1st of 2007. It's had its ups and downs. It's still in my portfolio. But most of my portfolio is constructed of companies I bought in different markets at different points in time because they're undervalued. We'll talk about what to do with these companies. They don't stay in my portfolio forever because they have to pass muster at regular intervals. But am I buying because I feel sure that I'll make money? Absolutely not. Investing is a game of odds. And to the extent that you trust your valuation, what you're hoping is you've tilted the odds a little bit in your favor. Not 90%, but 60%, 55%. That's all winning takes, is a little tilting of the odds. I feel comfortable enough with my valuation to buy the company. Am I comfortable enough to tell you to value Amgen? That's none of my business. I'll give you the framework. And if you're going to buy Amgen, my advice to you is take my story and make it yours, or change it to make it yours. I'll tell you what might have caused me to use a wildly divergent story. Let's suppose a new CEO had come into Amgen last year. A very overconfident, aggressive CEO. You know why I use the word overconfident? You know the most common characteristic of companies that do a lot of acquisitions is an overconfident CEO. So a new CEO came in last year, and the position's up. What would have been different about my valuation if that had been the case? I'm not going to go back to an average over the last 5 years because the new CEO clearly has a very different vision of how to grow. So I might have used a much higher reinvestment rate, but if you're buying publicly traded companies, you're not making 16.7 or 16% returns on those businesses. I might have used a higher reinvestment rate and a lower return on capital to reflect the fact that a new management has come into place. Will the value go up or not? I've got to work through the numbers. It might go up, it might go down. So that's one scenario. If I'd done this valuation in 2011 was when Obamacare became, you could argue that changed the game for pharmaceutical companies. So their pricing power decreased after that because you're now negotiating with 6 big insurance companies and Medicare. You know how that's going to show up, right? You might have lower margins, lower returns on capital because there's a macro event that's happened. What I'm trying to say is don't get too caught up in mechanical ways of doing valuation. This is what I always do because it has to reflect what the company looks like, what the world looks like, and how you're going to make those judgments for the future. As I said, I'll come back and talk about it. So if you look at the cost of capital for the company, basically the building block starts with a risk-free rate of 4.78%. This is the US dollar valuation. So you know what I was using as my risk-free rate? I was using the T-bond rate. Then I was getting down on my knees and said, please God, let there be no default risk in the T-bond. And this is something I'm going to come back to. Because when you use a government bond rate, you're assuming that governments don't default. And that is not true. Even in local currencies, governments default. So here, I'm making a judgment call. The T-bond rate is my risk-free rate, 4.78%. For the cost of debt, I added only 0.85%. You're saying, why is it so low? Because the ratings agency told me that Amgen was rated single A. For those of you not familiar with the ratings agency, they started AAA, work all the way down to D. A single A is a pretty safe company. And at the time that I did this valuation, the default spread for single A rated bonds was about 85 basis points. The 35% tax rate is my marginal tax rate. And let me make the point right here. When you do your cost of debt, I told you interest saves you taxes. But interest saves you taxes at the margin. Let me explain what I mean by that. Let's say you have $1 million in taxable income and you go out and you have $100,000 in interest expenses. Tell me how you're going to work out your taxes. You're going to take the million, you're going to subtract out the 100,000, you're going to report taxable income of 900,000, right? Think of where you saved on taxes. It's not on the first 100,000, it's not on the middle 100,000, it's on the very last 100,000. I used the marginal tax rate for the US in 2007 of 35%. So my interest saves me taxes at the marginal tax rate. My income gets taxed overall at the effective tax rate. I'm not being inconsistent. I'm just treating them differently because I'm asking different questions about taxes with the two. You know the early part of the word where interest is not tax deductible? Much of the Middle East, interest is not tax deductible. For religious reasons, actually, it's built into the tax code because interest is viewed as So if you're in Saudi Arabia, don't borrow money and have interest expense and expect to get a tax deduction because the tax code. You know what ends up happening is they use loopholes. They don't call it interest. They might call it something else. So it's something that's, it finds a different way in. But for much of the world, that tax advantage will kick in. So the after-tax cost of debt is 3.66%. For the cost of equity, I started with the same risk-free rate, the 10-year bond rate. But to get to my cost of equity, I looked at the price of risk in the equity markets in 2007. I want to be explicit. This number changes over time, and I'm going to show you how it changes over time. And in 2007, the price of risk in the U.S. equity market was 4%. The beta that I estimated for Amgen was 1.73. I come back, and this afternoon it's going to be all about where does the risk premium come from. But what am I telling you already about Amgen at the time that I did this valuation? Riskier than average or safer than average? Much riskier than average, 1.73 times more risky than average when I start the valuation. But by the time I end the valuation, it's getting much closer to an average risk company. That's the advantage I get because I allow the cost of capital to change over time. If my cost of equity, the company is about 90% equity, 10% debt to start the process of growing from a company. But again, as it becomes a mature company, I let the debt ratio drift up to the average across larger, more mature pharma companies, which is 20%. Everything in my discount rate is in motion. As my company changes above the line, I'm also trying to adjust my cost of capital below the line. Move on to a second company. And here I'm not going to spend as much time on the detail. I want to talk about what's different and what's similar. Second company I'm going to value is a company called Tata Motors. For those of you not familiar with Tata Motors, it's an Indian mass market automobile company with a really long history, goes back to the 1950s. It used to be privately owned. It's part of a family group called the Tata Group. And this is a valuation I did for Tata Group CEOs and CFOs in April of 2010. I chose to value Tata Motors in Indian rupees. That sounds like a stupid thing to say. You're saying it's an Indian company, what choice do you have? You can value any company in any currency. Currency is always the choice. In other words, if I gave you a Russian company, you can choose to value it in rubles, and God help you in coming up with a risk-free rate, risk premium, etc. Or you can value the same company in euros or US dollars. We'll talk about why currency choice shouldn't affect evaluation, but it's a choice. I've chosen to value Tata Motors in Indian rupees. I thought when I picked Tata Motors, I was going to get a nice, mature company with a long history that I could do the lazy things on. But in 2009, Tata Motors did two things that made my life difficult. I think they did it just to make my life difficult. The first is they did an acquisition that changed them entirely as a company. Does anybody know who they acquired in 2009? They bought Jaguar Land Rover. Overnight, they went from a mass market Indian automobile company to buying a global luxury automaker. The second thing they did is with a lot of fanfare, they announced they were going to make the cheapest car in the world, a car called the Tata Nano. A car so cheap that even Indians refused to buy it because everything was optional. Starting with the steering wheel. Do you really need a steering wheel? Just put a bullock in front of the car and make it draw you. But they were investing huge amounts, planning to sell $2,000 cars. What I'm trying to say is sometimes mature companies can do things that make them difficult to value again. They go through restructuring, they change their business model. So in 2010, when I valued Tata Motors, I faced these challenges. First, they bought Jaguar Land Rover, and the second was this nascent business they were in of producing the cheapest car in the world. Undaunted, I made my best judgments. Now, what I'm going to do is going to look very similar to what I do with Amgen because the drivers of value stay the same. I started by making the assumption that this is a company that had been around. Both Tata Motors and Jaguar Land Rover had been around long enough that their margins were stable. That might have been a bad assumption. But because I'm assuming margins are stable, I could boil things down to the reinvestment rate and return on capital again. I looked at the most recent year for Tata Motors, and the numbers were off the map. They made a lot of money, 20.1 billion rupees, but they had a huge net capex. You know why? What do I count in net capex? Acquisitions. The Jaguar Land Rover acquisition is driving the net capex to 31.6 billion. giving them a reinvestment rate of 171%. 171%. They had a pretty good return on capital coming primarily from the Jaguar Land Rover side. The return on capital was about 17.16%. So again, I'm faced with this challenge. What do I assume about the future? With Amgen, what did I do? I used a 5-year average. Remember? I used a trend line to make it. Here, I did not feel like a 5-year average would help me. Because for 4 years, it's just Tata Motors. The 5th year, they have Land Rover. I'm not sure what. So here's what I did. I went to the 2009 number. And I took out the acquisitions from the reinvestment. So in my story, you can see what I'm already assuming, right? That this is a one-and-done deal. They did a big acquisition. Unlike Amgen, where I'm assuming that average acquisitions will continue to happen, I'm assuming that Tata Motors has done this big acquisition that's going to take a huge amount of time for them to digest this acquisition. And therefore, the reinvestment I'm using is the reinvestment rate without the acquisition. You're saying, are you allowed to do this? Let me give you some good news and bad news. In valuation, in valuing companies, you're allowed to do whatever you want. You know what the bad news is? In valuation, in value companies, you're allowed to do whatever you want. Because sometimes you say, can't you give me some rules that tell you this is what you need? I cannot, because it depends on the company. Here, I think that they're not. If you disagree with me, it might be, hey, they're going to do an acquisition like this one once every 5 years, then your reinvestment rate is going to be higher. So my reinvestment rate of 70% is basically without the acquisitions. The return on capital, I looked across time, and there, if you combine the two companies, it was remarkably stable, around 17.16%. I left it where it was, rather than bringing it down like I did for Amgen. The growth rate that comes from it in rupee terms is 12% a year. So I expect 12% growth for the next 5 years and a reinvestment rate of 70%. That gives me cash flows for the next 5 years. Here again, I'm in year 6, I'm stuck. I said, what do I do now? I did the same thing I did with Amgen. I went to year 11. You think this year 11 must be magical. Every company becomes mature in year 11. I'll give away a secret. When I value companies, that number is either 0, 5, or 10. What do I mean if I'm valuing Toyota? What did I say about Toyota? It's already a mature company. You ask me, when will it be a mature company? My answer is already there. You can skip the forecasting cash flows, value the company as is today. If I'm valuing a Coca-Cola, which is mostly done with its growth phase, I might have a little bit of growth left from a few new products, but it's 5 years, and then I'm going to put you into mature growth. If you give me any other company, I'm going to stop in year 10. You're saying, why year 10? Why not 15? Why not 20? If you look at growth companies in the U.S., which is where you have the biggest database, do you know the median growth period for a high growth company in the U.S. is? How long do growth companies maintain growth? It's 3 to 5 years. Growth dissipates very quickly at most companies. 10 years is the 90th percentile. So I'm already telling you this company is special. It's different. It's going to make it to the 90th percentile. Are there companies that have grown for longer than 10 years? Absolutely. We can name most of them, right? And what does the fact that we can name most of them tell you about these companies? They're the exception, not the rule. You don't want to value a company to be the exception right off the bat, because then where's your upside? It's like, your kid comes back from kindergarten with a really good report card, saying he's going to Harvard. There's no upside now, right? Everything below Harvard now is a disappointment. You ended up at Duke, you loser, what's wrong with you, right? You don't want to start by building into your valuation the assumption that this is the firm that is going to break all rules. Because that's going to be icing on the cake. If it happens, you want it to be something that you can collect. So after year 10, I make Tata Motors a mature company. What do I need to do then? I've got to give it a growth that can sustain forever. I give it a growth rate of 5% a year forever. After I show you the next valuation, we're going to come back and talk about why these growth rates vary across valuations. Yes?
So is the growth rate that you're giving in year 10 fairly arbitrary? I mean,
that's a good question. It has to be less than or equal to the growth rate of the economy, right?
Yeah.
You think, where are you getting that number? What is my T-bond rate in the first valuation? Ordinary risk-free rate? 4.78%, right? What's my risk-free rate here? 5%. What's my risk-free rate when I value Archery? It's 11%. It's in lira. Turkish lira. What is my risk-free rate when I value a company in euros? It's 1%. You say, so what? You know what goes into a risk-free rate? Two numbers, expected inflation and an expected real interest rate. In the long term, your risk-free rate is actually an excellent proxy for long-term nominal growth rate in the economy. So here's what I'm going to do. I'm going to take your valuation, I'm going to look at your risk-free rate, and I'm going to let you use a growth rate below that number but not above that number. So if you're valuing a company in euros, guess what? You're stuck with a 0.5% growth rate in perpetuity. And don't you dare complain to me about that low growth rate. And here's why. What does that low risk-free rate give you as a benefit? Really low cost of capital. What one hand gives you, the other hand will take away. By linking my growth rate to my risk-free rate, I prevent what I call these inconsistent valuations, of which I've seen plenty in the last decade, where you have a company growing at 4% a year forever in euro terms and you're using a minus 0.5% risk-free rate. Tie your growth rate in perpetuity to your risk-free rate, and your valuations will stay internally consistent. Now, whether you leave it at the risk-free rate or below will depend on the company you're valuing. If I'm valuing an oil company, I'm going to leave it well below the risk-free rate. You know why, right? Fossil fuels, you're looking at a future that is a tobacco company. I'm going to give you a negative risk-free rate, a negative growth rate forever. But whether I push you all the way to the growth rate or below depends on your company. So here again, I push the company to stable growth. I give it a 5% growth rate. I bring its returns on capital down all the way down to the cost of capital, which is something I didn't do for Amgen, right? So what am I telling you about the two industries? In the pharmaceutical business, even mature companies will earn above the cost of capital. But I'm saying in the automobile business, that's not the case. And I'm going to back this up with data. I've computed the return on capital and cost of capital by industry for 100 different industries globally now for about 30 years. You know the collective return on capital for automobile companies is? It's actually below it's a terrible business. A good automobile company is lucky to make its cost of capital. So basically, I'm bringing in what I know by looking at the industry into that end result. So the return on capital, the return on capital in steady state is equal to the cost of capital. So as with Amgen, I'm bringing the growth rate down from year 6 to 10, the reinvestment down. So I'm nursing the company in my spreadsheet from being this 12% growth company down to a 5% growth company. Now the biggest difference though in the Tata Motors valuation is how I come up with the discount rate. Let me start with the cost of debt. What did I do for Amgen? I started with the risk-free rate and I added a default spread, right? In the case of Tata Motors, I start with the risk-free rate in rupees, 5%. And that was a lot more work to get than getting a risk-free rate in US dollars. And I'm going to take you through the process this afternoon. And I added 2 default spreads. You say, well, why 2 default spreads? The first default spread, a 4.25%, is Tata Motors' default spread based on its credit risk. You say, what's the extra 3% for? You know what that is for? It's for country default spread. This is extremely unfair because what am I telling you you have to do as an emerging market company? You've got to carry 2 burdens on your shoulder. One is your own risk as a company. The other is the risk of your country. You want to talk about unfair? Talk to a Greek company about what's cost them to borrow money for much of the last decade. You walk into a bank and say, I'm a Greek company. What does the bank say? 30% interest rate. But you haven't even looked at my numbers yet. You're a Greek company. Whether it's fair or not, emerging market companies carry the double burden. So in my cost of debt, I'm reflecting the double burden. I use the 33.99% marginal tax rate for India. My cost of debt in rupee terms is 8%. To get the cost of equity, I start with the rupee risk-free rate, 5%. And again, I promised you I'll come back and talk about how to get risk-free rates in rupees, rupiah, kwacha, whatever currency you want to work with. I take the beta times risk premium. That looks a lot like what I did for Amgen, right? Beta reflects the risk of the business they're in. The risk premium is the risk premium for a mature market. But then I add an additional risk premium. That additional risk premium is because they're an Indian company. In other words, because they get a big chunk of their revenues in India, I'm adding to their risk premium because operating in a risky country pushes up your cost of equity. I'll come back and talk later about how I come up with the risk premium for India, country risk premium, because I'm going to show you my global map of what country risk premiums look like around the world. But in 2010, my risk premium for India was 4.5%. This is the additional risk premium on top of my mature market premium. Now, one of the things that analysts do when they value companies in emerging markets that I think is wrong is they take every company in an emerging market and give it the same exposure to country risk premium. So every South African company gets the same additional premium because they're South African companies. Every Indian company, the same. And I think it's unfair for a very simple reason. Not all Indian companies are equally exposed to Indian country risk. In fact, the Tata Group is a great example to illustrate that difference. There's Tata Motors, but the biggest part of the Tata Group is a company called Tata Consulting Services. You know what Tata Consulting Services does? It's just outsourcing. In fact, many of you probably use TCS or Infosys for your payment processing. So Tata Consulting Services is an Indian company in terms of incorporation, but it gets 93% of its revenues in the US and Europe. You see where I'm going, right? They're both Indian companies. But I think Tata Consulting Services is less exposed to Indian country risk than Tata Motors. In fact, Tata Motors in 2009 was probably more exposed to Indian country risk than 2008 was more exposed to Indian country risk than 2009 for a very simple reason. The minute it bought Jaguar Land Rover, it was less exposed to Indian country risk because now it had revenues from outside India. I captured that in this valuation with an input that I call lambda. Lambda is just like a beta. Remember, beta 1 means you're an average risk company. Lambda 1 means you're as exposed as the average risk Indian company to Indian country risk. I gave them a lambda slightly below 1 because of the Jaguar Land Rover acquisition. I had a TCS valuation, Tata Consulting Services. Tata Consulting Services lambda was 0.20. Much less exposed because they got so little revenue. So I'll come back and talk about how I estimate the lambda, but I'm capturing exposure to country risk with that lambda and risk premium. Go ahead.
Does it make a difference whether you're valuing the company as a foreign investor as compared to a local investor in that country?
Yeah. I'll tell you when it makes a difference and when it doesn't. If I'm valuing a German company or a Brazilian company, it makes no difference because Brazilian and German investors have the same choices that I do, which is they can invest anywhere in the world. So I think of this as a global investor. I've got choices. I'll go where the choices are best. When I'm valuing an Indian company, it's messier, and here's why. I can invest in an Indian company and value, but if I don't like the way the Indian company is priced, I can go buy a German company, I can buy an American company, I can buy a Brazilian company. Indian investors still have restrictions. They're not as strict as they used to be on where they can invest. So let's take the limited case. About 20 years ago, Indian investors were not allowed to invest outside India. Then you created almost this market that's kind of where you're forced. You have no choice. Then the value of the same company can be different depending on whether you're an Indian investor or a U.S. investor, not because of currency, but because of the restrictions put on you as an investor. So in much of the world, I don't worry about this. But in parts of the world like India where you have restrictions on domestic investors, it does make a difference. Luckily, those restrictions are starting to ease, but they're still there.
But if let's say there's a complete control on the outflow of capital.
Then you've got a problem. Then you can have a domestic market that's so disconnected from the rest of the world that you create bubbles within these markets. You see why, right?
For example, Pakistan right now,
Yeah.
you can't invest.
It's a problem. I think the problem is when you create this market, we restrict outflows, you force people to invest in equities. So you're actually buying equities, even though you know you're not getting the returns you need to because you have no choice. But at some point in time, you know what happens, and this has happened in India before, and I'm sure it's happened in Pakistan before. When I keep asking you to buy equities, even though the return's only 3% and 4% and 5%, at some point you say, well, maybe I won't buy equities at all. You take your money out of equities and get gold. Yeah. And this is the problem you create when you restrict domestic investing, is you move bubbles around, right? Because you've essentially created a bubble market where people have to go to the least damaging thing they could go to. It's not good for the economy. It's not good for the market. And it's something that I've tried to kind of do. But you got to do this when times are good. You can't do it now because people, you have to do it when times are good. You got to open the valves a little, escape hatches, and hope that it happens. Yes?
I have a small question. So, what do you do in cases where, for example, you have Ignite, where you had a CEO that was totally crazy,
Right.
or in another case, for example, I'm thinking about SpaceX. It's valued at 150 billion. It brings in 1.5 billion, but Elon Musk clearly says he has only one objective: it's to go to Mars. Whether it makes
So why do
economically
you think
sense
people
or
have so
not,
much faith in SpaceX? What do you think gives it that?
they have clearly superior technology, but
This is the Elon Musk effect, right? If you take Elon Musk out of SpaceX, you probably lose 100 billion of that market cap right away. So part of it is the story of, hey, we're sending satellites into space. This is a big business, and we're the best at that business. We can launch 8 satellites a month, which is what they did last month, for instance. So they're way ahead of the game in terms of that. And it's a big business. But I think on top of that, you've got, and this is the positive aspect of Musk. There's a negative aspect we'll talk about later. The positive aspect is this guy has enough vision coming out of every orifice of his body that he's more than the remaining 499 S&P 500 CEOs put together. You're buying into vision, and he took you on a ride with Tesla, and look how well it's paid off. So I think in a sense, you're getting that Musk effect. And I tell people, look, you're buying a personality, not a company. The problem when you buy a personality is, personalities are human. I just ask as a what if, what do you think would happen if tomorrow you opened up your news feed and it said, Elon Musk checks into rehab? This is not, would you be amazed? Would you be completely floored? It's entirely within the realm of possibility, right? Given the fact that, think of what would happen to Tesla's value as a company, the story and its market cap in SpaceX. It's terrifying investing in personality-driven companies. This is why, when you look at Jeff Bezos, you've got to give the guy credit, which is until he bought the Washington Post in 2015, most people didn't know who the CEO of Amazon was. I remember in 2014 asking at a conference, does anybody here know who the CEO is? 10 people put up their hands. The rest said, I don't know. And that's a good thing, because in a sense, you're building a company that outlasts you. Much as I hate Microsoft, think of what Bill Gates did in the 1990s, right? Not only did he leave the company, he completely left the management alone. He said, this is Steve Ballmer who's the CEO. I'm not going to be looking over his shoulder. So in your personality-driven companies, your story for the company then reflects the pluses and minuses of that personality. So when I bought Tesla in June of 2019, I called it my corporate teenager. You know why I called it my corporate teenager, right? Do any of you have teenagers now? You were teenagers once. Remember what you do as a teenager? Every day you wake up, you look in the mirror and say, what can I do today to screw it all up? Because what is your time horizon is like 5 minutes. Basically, you can't think past. So you got a Harvard admission waiting. So what do? You go to a party and you do something really stupid that causes your admission to get withdrawn. I called it my corporate teenager. I said, this company has incredible potential. But there's one man who wakes up every morning and he says, what can I do today to screw it all up? Maybe I'll send a tweet about a Thai diver. What? Maybe I'll buy some Bitcoin on the side. Maybe I'll put some Doji coins. There are distractions, but in a sense, you get the package. You get the good stuff and the bad stuff. I'll tell you, the company is even more difficult than SpaceX. SpaceX, what about Virgin Galactic? What business are you in? Sending billionaires into space? Okay, how big is that market? Might not be a bad idea. There are quite a few billionaires I'd like to send on a one-way trip to space. But it is an incredibly difficult company to value because you have no idea what the end game is. Is it entertainment? Is it repopulating another planet? In which case you're getting way ahead of the game here because we haven't found a planet yet that can take us. So there are companies that are really messy, but notice at the heart of each of these, Richard Branson, you've got a visionary and people are buying into the vision. And I'm not saying it's bad or good. I'm not buying the company, but I'm not going to talk you off your decision if you decide that you're going to buy SpaceX because you trust Musk to make it a special company. He's done it before. And that's in fact something that's driving the Twitter. deal as well, right? That he can somehow fix this company that nobody's found a way to fix yet in terms of creating a business model. The bottom line here is I come up with the cost of capital in rupee terms. I discount the cash flows in rupees back at that cost of capital. The value that I get for the operating assets is 211 billion rupees. Then I add cash. So far it's looking familiar. And then I took a look at Tata Motors' balance sheet, and it freaked me out. Because they had holdings in 35 other Tata companies. And this is a feature, not a bug, of family group companies. It reflects a history. At one point in time, when there were private companies, they used to, this is part of the internal capital market. You're saying, so what? In order to value Tata Motors right, you know what I have to do, right? Value 35 other Tata companies. I'm lazy. I don't want to even do that. But even if I had not been lazy, I couldn't have done it because 2/3 of those companies were still privately owned. There was no information. So guess what I did to come up with the value of those cross holdings? I did something that still gives me nightmares. I trusted the accountants. You know what I mean by trusting the accountants, right? The balance sheet, they gave me value crossovers. Please, God, let this family be a good one. They're not lying to me and ripping me off. Remember, you're completely at the mercy of the family. That 100, but look at how much it is. In this case, 40% of Tata Motors' value is coming from its cross holdings. This company is 60% Tata Motors and 40% cross holdings. Divide by the number of shares, I got a value per share of 614 rupees. The stock was actually trading at 750 rupees. The CFO of Tata Motors was in the front row. I was doing the CEO. And he said, he put up his hand, and he asked a hypothetical question. I hate hypothetical questions, but I had no choice. He said, 6 months ago, a stock was trading at 510 rupees per share. Would you have bought our shares then? So I had to give him my honest answer. I said, I will never buy a Tata company. He said, what? We're a good family with a lot of good companies. And I said, buying a Tata company is like getting married. And right after you get married, your entire set of in-laws move into the bedroom with you. You see the analogy here? I want to buy Tata Motors because I like the company. What do you make me take 35 in-laws with you? I say, take this guy. No, I don't want those guys. You keep them. But guess what? You get the package deal here. It's a terrifying aspect of valuing and investing these companies. And Korea is full of these companies as well. You know, you look Samsung Group, every company owns cross holdings in other companies. It's a nightmare from a valuation perspective, but it does make it much more difficult for me, an investor, to have faith in my number because 40% of my valuation, I'm not doing the valuation. It's coming from an accountant. I have no idea how much faith I can put in that number. One final point, and then we'll end for the morning. We're approaching a new era, probably, of inflation. A lot of people in this room, especially if you worked in the US or Europe, have lived in a decade of low and stable inflation. The average inflation rate in the US between 2010 and 2019 was 1.7%, the lowest it's been over the last century. But even more telling, the variance in that inflation was 0.2%, the lowest it's been by far. So we've lived in a decade of low and stable inflation. And that decade might be ending. That's what we've seen in 2022, is markets are trying to come to terms with what do we do if inflation goes to 3%, 4%, or God help us, goes to 10%. So I'm going to show you the valuation of Archery, which is a Turkish company in 2019. Because remember, even though you've been used to stable and low inflation for the last decade, the Turks have been used to unstable and high inflation now for well over 7, 8, 9 years. But you get these brief periods where it looks like it's fixed, but it then comes back. There's a reason we'll talk about what the Turks do that I think fits the definition of insanity. Now, they've set up an economy that every 10 or 15 years is destined to have a meltdown. And we'll talk about what it is about Turkish companies that creates this. But you have high inflation. I'll show you what's going to change. First, I'll give you the good news. Inflation can act as a wind in your sails, allowing you to grow in nominal terms at a higher rate, right? So if you have 10% inflation, your growth rates can be 12, 14. It's not like you're growing fast, but inflation makes it. That's the good news. Here's the bad news. Take a look at what my risk-free rate is in Turkish lira in 2019. That number is now much lower than it is today. 11% risk-free rate. Think of what that's going to do. If you start with 11%, you build on top of it, you're going to end up with a really high cost of capital. When you have high inflation, here's what you're going to see. Much higher risk-free rates, probably much higher risk premiums, and here's why. When inflation goes up, it also becomes more unstable.